Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Byd Company Limited Annual Report. Byd Company Limited offers a diverse range of businesses and services across various sectors. At its core, the company operates in two primary segments: mobile handset components, assembly service, and other products. In automobiles and related products and other products. The mobile handset components segment focuses on manufacturing and selling mobile handset components such as housings and electronic components, while also providing assembly services. This segment is a significant contributor to BYD's overall business operations. In contrast, the automobiles and related products segment is involved in the production and sale of automobiles, auto-related molds and components, rail transport, and related businesses. The company also provides automobile leasing and after-sales services, as well as various battery products including automobile power batteries, lithium-ion batteries, photovoltaic, and iron battery products. In addition to its core business operations, BYD is also developing an urban rail transportation business, further expanding its reach into the transportation sector. Overall, BYD's diverse range of businesses and services positions it as a leading player in multiple industries, from mobile handsets to automobiles and beyond. Byd Company Limited market capitalization of $971 billion is significantly larger than the average industry peer of roughly $33 billion. This shows that Byd Company Limited holds a significant advantage in their industry. Byd Company Limited trades at a higher price-to-earnings ratio of 67 times and a higher price-to-book ratio of 3.48 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The leverage on the balance sheet appears elevated, with liabilities of 75% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The share count has remained broadly unchanged, indicating no significant dilution or buyback activity over the past 5 years. The income statement shows that the company have been growing its revenue annually and the operating income have been increasing. This shows that the business model works and the business is expanding. The company comfortably covers its interest expenses through operating income and maintains a strong cash position relative to current liabilities. Additionally, special charges appear non-recurring, suggesting high earnings quality and strong financial resilience. The primary drivers of revenue growth or decline can be identified through an analysis of the key points extracted from the summaries. On the revenue growth side, mobile handset and related products, as well as automobiles and related products, have been significant contributors to revenue growth, with increases of plus $617,381,933 and plus $620,730,928 respectively in 2024. Additionally, overseas operations have seen a notable increase of 21.15% in 2025 compared to 2024. On the other hand, joint ventures have experienced a decline in sales by 55.8%, while associates have seen an 8.3% decrease in sales. However, it is worth noting that revenue from principal operations and other operating revenue has increased in 2025 compared to 2024, as well as the total revenue. The only area where revenue has decreased significantly is contracts with customers, which saw a notable decline. It's also important to consider exchange rate fluctuations, which had an impact on net profit and shareholders' equity, but did not directly indicate revenue growth or decline. Furthermore, investment allowance and impairment provision have also been noted, with Byd Co. Limited seeing an increase in investment allowance of plus $7,844,880, while Byd Semiconductor Company Limited saw a decrease of minus $2,178,544. $535 in investment allowance. The net income of the company experienced a significant decline between 2024 and 2025, with a decrease of 18.8% from RMB 41,587,940 to RMB 33,760,758. This reduction is also reflected in the operating profit margin, which decreased by 11.3 percentage points from 51.9% to 40.6%. The gross margin also saw a decline, decreasing by 1.2 percentage points from 95.3% to 94.1%. The decrease in net income and profit margins can be attributed to various factors. One possible reason is the increase in operating costs, which may have offset some of the revenue generated by the company. Additionally, the reduction in gross margin suggests that the company's pricing strategy or cost structure may need to be reassessed. Furthermore, the significant decrease in operating profit margin from 94.3% to 88.6% indicates a substantial decline in operational efficiency. This could be due to various factors such as increased competition, changes in market conditions, or internal inefficiencies within the company. Overall, these changes suggest that the company needs to reassess its business strategy and operations to improve profitability and competitiveness. The company's financial performance suggests a strong ability to generate positive operating cash flow. On page 58, the company reports RMB 133,454 million in positive operating cash flow for 2024 and RMB 59,136 million for 2025. This is further supported by pages 148 and 299, where net cash flow from operating activities is stated as positive in both years. Additionally, page 225 confirms that the company's operating cash flow was positive in 2024 at RMB 62,298,988 and in 2025 at RMB 37,004,685. The most direct statements on this matter can be found on pages 300, 301, and 309, where it is explicitly stated that the company is generating positive operating cash flow. Overall, despite some conflicting information across different pages, the majority of evidence suggests that the company is indeed generating a significant amount of positive operating cash flow. The company's debt level has undergone significant changes over the years. Initially, total borrowings increased substantially from RMB 28,584 million to RMB 113,435 million. However, despite some fluctuations, the overall trend indicates an increase in debt levels. This is evident from the fact that even though there was a decrease of 40.6 million in debt level from 2024 to 2025, the overall trend shows an upward trajectory. In terms of interest expenses, there has been an increase from 2021 to 2023, followed by a decrease from 2024 to 2025. The exact figures show that interest expenses increased by RMB 457,876 in 2025 compared to the previous year. This indicates that while the company's debt level has increased significantly, its interest expenses have shown some fluctuations over the years. The company's performance across various regions and segments has been mixed. On the positive side, certain areas have shown significant improvement. The cultivation of management talent and skilled talent training have been successful initiatives, as evident from page 61. Additionally, the construction of a digital learning platform has also yielded positive results. Furthermore, the mobile handset components, assembly, and other products segment has performed exceptionally well, according to page 345. This segment's success is a testament to the company's ability to innovate and adapt to changing market demands. On the other hand, there are areas where the company has struggled. The automobiles and related products and other products segment has been underperforming, as noted on page 345. Despite efforts in other areas, this segment remains a concern that needs attention and improvement. Management is optimistic about the company's future prospects. According to management, the upcoming 15th five-year plan will see a smooth start with strengthened macroeconomic policies. This favorable environment is expected to drive growth in new energy passenger vehicles, thanks to technological advancements, shifting consumer preferences, and supportive policy guidance. In addition to external factors, management is also focusing on internal development by investing in talent cultivation programs. These initiatives aim to build full-chain management skills for key positions, ensuring the company remains competitive in the market. Financially, the company appears stable, with sufficient working capital to meet its liabilities within the next 12 months. Furthermore, management has strategically diversified investments through equity instruments, totaling RMB 8,610,322. These moves demonstrate a proactive approach to managing risk and positioning the company for long-term success. The company has a history of rewarding its shareholders through dividend payments. Over the past decade, from 2016 to 2025, the company paid out a significant amount of RMB 277.36 billion in dividends to its shareholders. This demonstrates the company's commitment to sharing its profits with its investors and providing them with a return on their investment. Furthermore, the company has also confirmed that it pays dividends, with an amount of RMB 3,263,957,000 being paid out, as per the financial records. This confirms that dividend payments are indeed a part of the company's financial strategy, allowing shareholders to benefit from its success. There are indications that the company may be facing concerns related to inventory buildup and supply chain disruption. The data suggests that the inventory turnover period has increased from 61 days in 2024 to 72 days in 2025, which could indicate a potential issue with managing inventory levels. Furthermore, the raw materials and finished goods inventories have seen significant increases of 20.35% and 48.55%, respectively, over the same period. Additionally, the impairment rates for these inventories are higher in 2025 compared to 2024, which could be a sign that some of this inventory may not be saleable. However, it is essential to note that these concerns do not necessarily indicate significant issues with inventory buildup or supply chain disruption. The provision for inventory impairment is RMB 701,748, but this amount is relatively small compared to the overall inventory levels. Therefore, while there are some warning signs, they may not be indicative of a major problem at present. That concludes the financial summary for Byd Company Limited. Feel free to comment below, and I will be happy to answer them when possible.